Let's get back to those Canadian retail sales. There was a sluggish end to 2025, but it looks as though there was a mild rebound last month. And the Fed, of course, has another data point to digest. US GDP falling short in the latest quarter. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much indeed for joining us. Start off with the retail sales, if you would. Are they an important metric for the Bank of Canada?
Good morning, Andy. I would say yes, they are an important metric for the Bank of Canada. Having said that, it's not like the U.S., where U.S. is a consumer economy, where the consumer spending drives the economy. I would say in Canada, we're more of a housing economy, from the jobs created through housing, as well as the spending for durables because of housing is a bigger driver. So retail sales is important. The Bank of Canada will be encouraged by the number that we see. We'll have to see if this trend continues or if the actual number is close to the preliminary estimate. But it is a good thing, and I think it reflects increasing consumer confidence.
Looking at the fixed income markets broadly, you think there are increasing signs that investors expect one cut from the Bank of Canada, interest rate reduction this year?
Yes, and what's interesting is towards the end of 2025, the market was expecting a hike or a percentage, a chance of a hike in 2026. Our team did not believe that. We always believed there'll be cuts in the market. We were calling for 1 to 2 cuts in 2026. Despite the market discounting hikes, we still believe there's going to be 1 to 2 cuts. We ultimately believe there'll be 2 cuts this year. And the main reason why is CUSMA. The uncertainty around that. You saw in the Bank of Canada minutes that they actually highlighted increased uncertainty because of Donald Trump. And to me, that's like words that open up the easing possibility again. And we think if they're going to ease once, they don't ease once. You know, if you're going to ease, you ease twice, because you think you need to impact the economy somehow.
The housing market, you don't see much of a turnaround there this year?
No, unfortunately not. We don't see much of a turnaround just because of the inventory overhang. You have to get rid of the inventory overhang in regards to new condos, new townhomes being built. The key way to doing that is lower interest rates. You lower the price, the entry costs of housing affordability. That's helpful in getting rid of that overhang. We do, however, believe that the overhang will be taken care of in 2026. So we do see us coming close to the lows, but we haven't turned around yet.
What about the States? A weakish number for the latest period on GDP. What is your take on the U.S. economy? Is it just ticking along nicely?
Yeah, ticking along very nicely. And when you look at the details of the surprise weaker number in GDP, the biggest driver was government spending, or lack thereof, and that was driven by the shutdowns. So a little bit of noise in those numbers. They're actually better than they look, because if you kind of remove the government shutdown. So yeah, we're very constructive of the U.S. We believe they're on an upswing from a growth perspective, and we believe this will be the low print for, represents 2025, but the low print in 2026. So
can President Trump claim that he's done a decent job of preserving, keeping economic growth solid, even though, despite the massive disruption around tariffs?
Yeah, you know what? I smile because I think he'll proclaim that no matter what the number is. Right?
That's true, yeah.
If it's a low number, it's someone else's fault. If it's a good number, it's his. So he'll proclaim that it's good without a doubt. But yes, and you have to remember, the key thing in the U.S. right now is that the tax refunds are coming out. They're going to hit consumer pockets, and that is expected to be significant due to the tax reduction from the Big Beautiful Bill. And those refunds come February, March, April. So we expect that to be very supportive of the U.S. economy, at least for the next several months. And we think that'll play throughout the year.
And just finally, we're very tight for time, but you're generally saying if you have a bond portfolio that you're managing, keep it short because there could be drops in bond prices, rises in interest rates?
Yeah, we're saying two things. You want probably a maturity of around 5 years because there's more volatility outside of 5 years. And the second thing, which I think is more important, you do want to have own corporate bonds. We do believe this is a supportive environment for credit, for risk assets, and we are overweight credit and risk assets, and we'll go more overweight if the opportunity presents itself.
We'd better jump. Earl, thank you very much and have a great weekend.
Thank you. You as well.
Earl Davis, head of fixed income and money markets at BMO Global Asset Management.